The truth about selling a restaurant in 2025. What we sell restaurants learned from hundreds of deals. Part 3. This is the third and final article in a three-part series on the restaurant resale marketplace in 2025, offering insights that both buyers and sellers should understand as they prepare for 2026. If you have been following this series, you already know that successfully selling a restaurant requires far more than putting a listing online and waiting for inquiries. After more than 2 decades and thousands of transactions, We Sell Restaurants has developed a deep understanding of what actually moves deals forward. The first article explored what it truly takes to sell a restaurant and how timing influences outcomes. The second focused on documentation and why incomplete or disorganized records derail transactions. This final installment takes a different approach. 2025 proved to be a particularly interesting year in restaurant resales. It reinforced some long-standing principles while delivering a number of genuine surprises. These were the outcomes that left buyers, sellers, and even experienced certified restaurant brokers pausing and reassessing assumptions about the market. With hundreds of transactions completed, the following trends and outcomes stood out because they either defied conventional wisdom or revealed shifts in buyer behavior that were impossible to ignore. Biggest surprises of 2025. Surprise number 1. Ghost kitchens and virtual brands mostly failed to sell. Entering 2025, ghost kitchens and delivery-only brands were widely expected to be strong performers. Built during the pandemic and positioned as lean extensions of restaurant brands, they appeared to offer lower overhead, minimal staffing requirements, and delivery-driven scalability. The reality was very different. Most ghost kitchens did not sell. Those that did sold at significant discounts. Buyers increasingly recognized the risks. These concepts lacked physical presence, meaningful customer loyalty, and community visibility. Revenue depended almost entirely on third-party delivery platforms that often take commissions near 30%. A change in platform policies, fees, or algorithms could undermine the business almost overnight. The few ghost kitchens that did transact successfully were not standalone operations. They were tied to physical restaurant locations, using excess kitchen capacity to expand delivery reach. Buyers viewed those setups as operational enhancements, not core businesses. The takeaway was clear. Ghost kitchens can be useful as a growth strategy when paired with an existing restaurant. As independent investments, buyer appetite has faded sharply. Surprise number 2. Fast casual dominated buyer interest. Fast casual concepts continued their strong momentum, accounting for nearly half of all units sold in 2025. While the category has been popular since 2020, this year pushed demand to another level. Sub shops, sandwich concepts, and pizza restaurants consistently attracted the strongest interest. Full-service restaurants, by contrast, faced greater resistance. Buyers were drawn to fast casual for practical reasons. These businesses typically offer mostly daytime hours, lower labor costs, simpler operations, reduced alcohol liability, and consistent traffic patterns. Many are franchise models, which further supported buyer confidence and stronger valuation multiples. We saw fast casual restaurants receive multiple offers within days of listing. In many cases, buyers competed aggressively, pushing deals toward the higher end of valuation ranges. The dominance of franchise fast casual concepts further reinforced this pricing strength. Surprise number 3. Experienced operators paid more, not less. Conventional wisdom suggests that experienced restaurant operators negotiate harder and pay less. In 2025, the opposite was true. Multi-unit owners and seasoned restaurateurs frequently paid premium prices, often close to asking, because they understood value differently. They moved faster, conducted more efficient due diligence, and were less alarmed by minor operational issues. Financing was typically in place, allowing for quicker closings. First-time buyers, while enthusiastic, often struggled to separate material risks from normal wear and tear. Deals stalled over small repair requests, extended consulting demands, or minor equipment concerns that seasoned operators viewed as routine. One example stood out. A casual Mexican restaurant listed at $465,000 attracted interest from both a first-time buyer and an experienced operator. The first-time buyer offered $425,000 and requested a new walk-in cooler, parking lot repairs, and 6 months of post-sale consulting. The experienced operator offered $470,000, accepted the restaurant as is, and closed in 30 days. He understood the remaining life of the equipment and focused on long-term opportunity. The experienced buyer secured the deal. Surprise number 4. Secondary markets outperformed major metros. Large metropolitan areas were expected to dominate transaction volume and pricing. Instead, restaurants in secondary and tertiary markets performed exceptionally well. Lower rent, less competition, and strong community loyalty played a significant role. Buyers were also seeking better quality of life and lower operating risk, particularly as downtown areas continued to struggle with reduced traffic following years of workforce shifts. An independent diner in a town of 35,000 sold at a higher-than-expected multiple because it was a community institution with decades of consistent performance. Meanwhile, urban restaurants with high rents and tight margins struggled to meet buyer return expectations. Stability proved more valuable than trendiness. Surprise number 5. Younger buyers were more conservative than expected. Buyers under 35 were expected to be bold and experimental. Instead, they were the most conservative group in the market. Younger buyers gravitated toward established concepts with long operating histories. Pizza, breakfast, and fast casual dominated their interest. Experimental, niche, or heavily rebranded concepts were often avoided. Student loan debt, limited capital, and heightened awareness of failure rates shaped their approach. These buyers could not afford costly mistakes. The dependable neighborhood restaurant often felt like the safest path forward. What this means for 2026. The lessons from 2025 point to a market that rewards preparation, transparency, and real. Sellers who succeeded were not always those with the newest concepts or prime addresses. They were the ones who aligned their offerings with what buyers actually wanted. If you are considering selling in 2026, the implications are clear. Pricing correctly from day one matters more than ever. Inflated pricing leads to stagnation, not leverage. Professional valuation and realistic expectations allow sellers to achieve full value without chasing the market downward. Documentation must be organized well before listing. Financial records, leases, and operational details are no longer optional. Buyers are thorough, and incomplete information delays or kills deals. Honesty about current performance builds trust. If 2025 was slower than prior years, transparency upfront prevents credibility issues later in due diligence. Timing remains critical. Early in the year continues to deliver the strongest buyer activity, though well-prepared listings can succeed year-round when marketed properly. Sellers should also think beyond the asking price. Flexible terms, seller financing, retained real estate, cosmetic improvements, and strong transition support often determine whether a deal moves quickly or lingers. Financing options continue to expand, including unsecured lending based on personal credit. While this opens doors, it also introduces fragility late in the process if buyers are not disciplined. Looking ahead, we expect continued demand for fast casual and proven concepts, deeper scrutiny of recent financials, faster closings for well-prepared listings, and increasingly sophisticated buyers. The restaurants that will thrive in 2026 are the ones that present as smart investments, not gambles. Clean financials, solid leases, consistent performance, professional presentation. If you are thinking about selling, now is the time to prepare.